What happens if the markets crash? How to protect your portfolio? Is this your last chance? Okay, so by the end of this video, you will know how to run a successful investment portfolio as well as protecting it from market collapse. It ain't what you don't know that gets you into trouble, it's what you know for sure that just ain't so. Now, this quote was attributed to Mark Twain in the film The Big Short. Now, some of you, if you're very much into your investing, may have seen this movie. It features Brad Pitt and lots of other famous celebrities. Now, this big film called The Big Short perfectly explains the 2008 global market collapse and recession that had an extreme effect on the markets across the world, specifically in the United States. Now, what happened in this 2008 financial crash? Well, to put it simply, the 2008 financial crash was a crisis that was caused by a number of factors, including predatory mortgage lending, which is low quality loans which were made to people who couldn't afford to pay them, putting them at high risk of default. This is essentially giving people loans of money that they know they cannot afford to pay back. There was also unregulated markets. Banks and other institutions were able to borrow heavily to invest in these loans without any oversight. There was also a house pricing bubble. Cheap credit and tax lending standards fueled a house pricing bubble. And of course, a big factor, if not one of the biggest, was toxic assets. These were loans that were packaged and resold to financial institutions and investments, creating toxic assets. Essentially, what happened was consumers were originally sold very good assets, but when all of those good assets were sold out, they were left with the toxic assets, the ones that no one really wanted. So they basically packaged them up into a big nice gift bag and sold them off as a nice diversification of great assets. But essentially what consumers were buying and investing in was toxic assets. And finally, one of the major factors as well was the interbank market freeze. When the bubble burst, the interbank market froze because no one knew how widespread the losses really were. And this had a massive effect. Basically, the banks panicked and the interbank market freeze essentially stopped everything, all trading, everything in that specific moment. One, because they didn't want it to get worse, and also because they didn't really want people to realize how bad the situation really was. Now, why is this story relevant? Well, I want to show you how when you're at your highest moment, be careful, because that's when the devil comes for you. And that's exactly what happened in 2008. The economy was booming, people were getting loans left, right and centre, people's investment portfolios were brimming with all sorts of different assets, but no one really knew what was coming. And unfortunately, when the dust settled from the collapse, $5 trillion in pension money, real estate value, 401k, savings and bonds disappeared. 8 million people lost their jobs, 6 million people lost their homes, and that was just in the United States. So how do we go about protecting our investment portfolio? Is this your last chance? I mean, the world right now is in a lot of turmoil. We've got the war in Ukraine. We've got the Middle East conflict, and NATO and all of the Western countries, for some strange reason, are getting involved with that. We've got a new president in the United States, Donald Trump. We've got all sorts going on in the Western world right now. And that, of course, has to be monitored and has to be looked at for possible, economic downturn coming forward in the future. So how do we protect our investment portfolios? Well, the first rule of an investment is don't lose money. The second rule is don't forget about the first rule. Now, that's a fantastic quote that I absolutely love from Warren Buffett. And that's a quote that I think is often not remembered. And I think it's so true. The first rule about investment is don't lose money. The second rule is don't forget the first rule. And it's so, so true. How do we do it? How do we protect our investment portfolio? Well, for me, diversification, diversification, diversification. Spreading your risk. It's extremely important. Don't put all of your eggs into one basket. Make sure your investment portfolio is balanced and then rebalance it, and don't overweight. What I mean by don't overweight, don't get so tunnel vision on one single investment. And listen, it's easily done. We've all been there, myself included. When you find a new investment vehicle that you truly believe in, we as humans tend to put all of our effort into that one single thing. We tend to focus on the thing that we really enjoy in that specific moment. And it's important not to do that when it's coming to your investment portfolio. You need to make sure you spread your risk by diversifying. What do I mean by that? Get multiple different funds and investments. You need gold bullion, you need index funds, you need property, you need a speculative investment, maybe cryptocurrency. You really need to diversify, because not only are you spreading your risk, you're also giving yourself a chance of yielding greater results, because you're spreading yourself across a better board. Talking about gold, like we briefly just mentioned, this has to be a massive, massive point for me in protecting your portfolio. You can have index funds. Let's say the S&P 500, one of the world's best, if not performing best index fund. Yes, it's fantastic, but if the United States economy was to crash, so would the S&P 500. Okay, maybe you're going to say, well, property, investment buy-to-let property, HMOs, houses of multiple occupation. Well, if there is a property bubble and we don't know it and it bursts, you're going to feel that. Whereas when we look at gold, gold has been a steadfast security investment, a backbone of investors' portfolios for thousands of years. Let's just take a look at some examples to prove the point. So in the last 45 years, the average compound growth of gold has been 6%. 6%. Now, okay, that doesn't sound like a lot, but when you're talking on an average over 45 years through everything, such as the 2008 financial recession, which was global, to still retain an average percent of 6 is fantastic in my opinion. We can look at the last 20 years as a yielding perspective. It's up 783%. Unbelievable. Or if you were to invest £10,000, it would be worth £88,500 in those 20 years. So protecting your portfolio. There's multiple ways to do it, but for me, diversification, 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 and single focus, if you're going to do it, on gold. It's been around for 4,000 years. It's proven to be the backbone of all investors' portfolios. Now, something to remember, of course, is nothing's a sure thing. But when it comes to investing, as it stands, gold has to be the best investment you can make to protect your wealth. I often like to say that, gold isn't going to make you rich, but it's certainly going to keep you rich. Now, my own personal investment plan definitely involves diversification, 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 and gold. It's a no-brainer for me on protecting my portfolio. Now, the key. What is the key, essentially? Well, it's to not get complacent. Just like in the 2008 financial global recession, people got complacent. There were so many great offers getting thrown in people's faces. Loans for people that couldn't afford them. Easy to buy properties. Assets that were deemed to be the best asset at the time. When things are usually too good to be true, it's normally because they are. So make sure you're constantly reevaluating your portfolio. Not only does this help lower your risk, but it gives you an opportunity to rebalance your portfolio to the changing and emerging markets. By doing that, you're not leaving yourself stale and open to big suffering wounds that could potentially come when there's economic downturn in the markets. And I'd like to also say, assume you're wrong. I personally believe in my investment portfolio, my diversification, and my investment vehicles. But what if I am wrong? What would my opponent invest in? What would the person betting against me invest in? By doing that, you're looking at it from a different perspective, a different mindset, and you're trying to stay out of that tunnel-based vision investment process. Now, in conclusion, what have we learned? We've learned that investing comes with risks, no matter whether it's gold bullion, S&P 500 index funds, property, crypto, it all comes with risk. And what goes up must come down. But that doesn't mean you can't protect yourself with being diversified, investing in assets like gold or commodities that have proven to be wealth preservation devices against inflation and against economic instability. I will say that you don't have to be extreme, just be consistent. Whether it's investing consistently on a compound average basis, whether you're investing on a dollar cost averaging basis, just be consistent, whether it's reevaluating your portfolio or doing all of that in between. And remember, enjoy the journey, because otherwise there's literally no point in doing it. Thank you very much for watching. I hope you've enjoyed this video. I thoroughly enjoyed filming this one for you. I love getting into the nitty-gritty stuff when it comes to financial topics of instability in the market, future and past financial topics as well. I really do find it very interesting, and I'm looking forward to seeing what the future holds for my investment portfolio and your investment portfolios as well. Thanks very much for watching. If you've stayed till the end, please consider smashing that like button. It really shows me you enjoyed this video and that you'd like to see more content just like this. If you are interested in seeing more content, or you just really want to let me know you enjoyed, click the subscribe button so you don't miss any of our future content. Leave a comment below. I'd really appreciate it. Until next time, I'll see you all in the very next episode. Bye-bye.